Hello and welcome everyone to my channel, The Quality Investor. Yesterday, Walgreens Boots Alliance, ticker WBA, released their earnings. It was a travesty. It is another dismal chapter in a company that has seemingly been restructuring since 2010. Let's go through a brief history of that travesty. 2010, Walgreens restructures healthcare units, Reuters. 2015, after merger, Walgreens plans $1.5 billion in cost cuts, CFO Magazine. And this is after the merger with Alliance Boots, a European pharmacy retailer. 2018, Walgreens aims to save more than $1 billion in cost-cutting plan, New York Post. Mid-2023, Walgreens expects to close 150 stores, CFO says. Fox 59. It is one cost-cutting plan after another for over a decade, a clear sign of bad management decisions. And yesterday morning when their earnings were released came the most shameful cut of them all for the 47-year dividend aristocrat. A 48% cut to their dividend. With that move, former dividend aristocrat Walgreens severs 47 years of shareholder trust with this move done to, and I quote, CEO Tim Wentworth, reinforce our goal of increasing cash flow while freeing up capital to invest in sustainable growth initiatives. Classic executive speak, but not actually far off the truth. Walgreens fiscal year 2023 free cash flow was a paltry $141 million. They also have $784 million in cash versus a staggering $29.7 billion in long-term debt and lease obligations. Cash is the lifeblood of a business, and given that most of Walgreens' debt is lease obligations, you can say they are house rich and cash poor. All right, let's get into the earnings. But first, if you enjoy content like this, please hit that like button and subscribe to the channel. Also, hit that notification bell so you can know right away when I post more stock analysis content. I've used Walgreens as an example of a poor quality business in other videos that I've done, and this earnings release did nothing to change my mind on that, at least in the near term. So I want to get into the earnings and point out some more details of what makes Walgreens a poor quality investment aside from the headline grabbing dividend cut. Walgreens has always been a pharmacy retailer. However, after their 2015 merger, they pivoted to becoming a healthcare provider with primary focus on urgent care. To me, it seems like they're attempting the European model of pharmacies here in the US, where care is a part of the business. Given that the 2015 merger was led by the European side of the deal, it makes sense. Looking here at their earnings release, we can notice right away in the highlights section, the first quarter loss per share was 8 cents loss compared to the loss per share of $4.31 a year ago. So an increase, I suppose. And however, they also did increase their sales year over year. First quarter sales increased 10% year over year to $36.7 billion. But here is the big headline, announcing a 48% reduction in quarterly dividend payment to 25 cents per share. Walgreens also is maintaining their 2024 adjusted EPS guidance of $3.20 to $3.50 per share. And on the earnings call, the CEO, Tim Wentworth, made a couple points that I thought were interesting. They're aiming for $1 billion in cost savings this year, including a 20% reduction in headquarters support staff. So layoffs are coming. He also really emphasized what they're doing in the healthcare provider space, like attracting pharmacists, such as partnering with academia and pharmacy schools to attract the next generation of pharmacists. And they're really focusing on expanding their services in the healthcare provider space. He noted one of their healthcare provider acquisitions, VillageMD, is on track to achieve a significant year-on-year profit improvement, and that they're leveraging VillageMD's expertise to grow their patient panel. So it does seem that they're going all in on becoming a healthcare provider and shifting away from retail. However, it will take a few years to get there, and it's going to be a bumpy ride along the way. Here is a slide from the earnings presentation that reinforces what the CEO said on the earnings call. I just wanted to point out how they put this 48% reduction in quarterly dividend payment in here so nonchalantly, just completely ignoring the fact that they destroyed 47-year track record of dividend increases. Here is a slide showing their very high level income statement. So you can see those 36.7 billion in sales, 10% increase, and that GAAP earnings per share loss of 8 cents a share. And I did want to point out that last year, first quarter of 2023, they did have a 5.2 billion charge for opioid related claims in a lawsuit that they did have a charge for. But that lawsuit, those claims, that's still on the books as a liability. So as they pay out those claims over the next couple of years, that will hurt their free cash flow. And this is a breakdown of that healthcare segment that Walgreens is trying to pivot to. I want to point out how small it is right now in comparison to the overall business. Remember, they had about 36.7 billion in sales. Right now, only 1.9 billion of those sales are from their healthcare financials. Granted, it is the US segment. So they do have a long way to go in order to complete this transformation of the business. Although we are seeing some growth here, Village MD plus 14%, and another acquisition, Shield, is up 27%. So they're growing the business, but it's going to take time. And finally, this slide here is a breakdown of their full year guidance and some of the tailwinds and headwinds they expect. In the tailwind section, I just wanted to say tax rate favorability. Basically, that means because they had a loss last year and in previous years, they're allowed to carry forward that loss. So, it's not like their tax rates are going down. They're just carrying forward losses from previous years. And then also further consumer spending pullback and shifting behaviors as a headwind. I don't know. This is anecdotal. When I was at stores over the holiday season, I didn't see any real downturn. I saw every store I went to was packed. When I did go into Walgreens, however, they were empty. So they're saying they're seeing this as a shifting behavior. Personally, I saw it as nobody wants to go to Walgreens. Looking at here is the non-GAAP adjustment to the operating earnings. And you can see there's a lot of charges that they took in their operating earnings. They added back to get down to this positive 726 million of operating earnings. So basically what that means is Walgreens doesn't consider these as ongoing operational charges. So they're one-time charges in their view. While that's true, to me, it's a red flag of bad decisions. So the first one here, acquisition-related amortization. Basically, when you acquire a business, you have to record an intangible or goodwill asset on the asset side of the balance sheet. And if something within that business gets impaired, you have to take a write-down per GAAP. That's basically what this acquisition-related amortization charge is. They had a 275 million write-down, meaning management, after the acquisition, destroyed value for the acquisition. This next one here, acquisition-related costs, $163 million charge. Basically, they did divest an unprofitable business and they took a loss in the deal. And the other one here, transformational cost management, $109 million charge. This is related to their restructuring plan. But as I said at the outset of this video, it seems like they're always in a restructuring plan. So I don't know, maybe this is an operational charge. However, the point is, all of these together just point to very bad decisions by management. One in isolation isn't too much to worry about, but there's 6 of them here. And this is an ongoing thing. And what we're looking at here is a 10-year snapshot of some of the more important metrics for Walgreens. And you can just see it's just not a pretty picture. Very flat revenue growth. Earnings per share has just been declining. They had some good years in 21 and 22, but terrible 2023. This is as of their last fiscal year end. They have been buying shares back, but in this case, should they really be doing that at this point? But you can see here, cash versus debt. I mean, their debt has skyrocketed in the last 4 years or so. And that's really shot their debt to equity up as well. But to me, the cash flow here is really the most concerning. You can see since 2018, it's just a steady decline. And it's not that CapEx has really exploded, thus lowering free cash flow. Their operational cash has declined very much. And that's the reason for the dividend cut. They're really hurting on cash. And you can see that here. They barely have any cash on the books. And of course, margins are also very much in decline. You never want to see margins declining like this. And on a profitability side, the return on invested capital, return on capital employed, also just a steady decline. So to me, this really paints the picture of just the poor shape that Walgreens really is in. And the management has seemingly made one bad decision after another. There's no metric here that's shown any real improvement over the last 5 years, 10 years. And to me, I just don't have a lot of confidence that this current management is going to turn this around soon. Maybe they will, but there's a lot they're going to have to show over the next few years to even start making this a consideration as an investment again. A dismal quarter for Walgreens, and nothing in their earnings release signals a reversal of these downward trends. It remains to be seen if their strategy to become a healthcare provider works. In the meantime, this is a business that I would personally avoid. So before we go, I do want to remind you that this is not financial advice, and I do not own a stake in Walgreens. With that, thank you for watching today's video. And what do you think? Let me know in the comments below. Also, please hit that like button. And if you found this info helpful, consider subscribing to the channel and joining our community. Thank you and happy investing.